The worse that gets, the more we are going to have that long-term problem. And it's just, you can see it in the numbers. It's just a matter of numbers. We are near that inflection point.
So higher for longer keeps being the mantra for the central banks. The markets believe that the Fed is going to pivot. In the meantime, debt right now is a whole lot more expensive via interest rates than it used to be for the 15 years that they kept it at zero interest rate policy, or in other words, ZIRP. Well, this is a problem because that debt just keeps growing and growing and growing. Has that gotten better? Or what are the implications for you and me? Let's talk about this coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. And by the way, if you haven't gotten your strategy in place, click that Calendly link below. We are running out of time. And I'm going to start out with Ray Dalio, who expects a revolution. And you guys know I agree with him, and I think we need it badly. But he's also saying that the U.S. is reaching an inflection point where the debt problem quickly gets worse because that all of that interest, it's like a hockey stick up now, right? So that can crowd other things out, and we're going to talk about that today. But soaring U.S. government debt is reaching a point where it will begin creating larger problems. Economically strong means financially strong. And right now, this I think is interesting. The government spent $659 billion on net interest costs in fiscal 2023 to finance the debt. Now, here's the thing about that, though. When they don't take in enough money, and we're going to look at this, when they don't take enough money in to pay all the interest on the debt and then any of the principal, all of that interest goes into the principal and it compounds, and it compounds very rapidly, especially in a higher interest rate environment. So I thought that was interesting. But you want to keep spending at the same level. There is the need to get more and more into debt. The way that works, it accelerates. We are at the point of that acceleration, which creates a supply-demand problem. In other words, our government's issuing a whole lot more debt. Who's going to be buying it? We've been talking about this. It's made worse by the other issues that we're talking about. The internal political issue, the internal social conflict issue. Yeah, and China in particular, looking at all the issues that the U.S. has and others as well. China in particular has cut its holdings strongly, pulling back 17% during the period. This is the problem when you're in a debt-based system. When you get to a point where it's not just that it's not sustainable, but it is not payable, and you need to take on more and more debt to pay the debt that you already have, at some point, creditors say no. And we are getting rapidly to that point. And actually, in some cases, we're already there. U.S. credit rating outlook changed to negative by Moody's. Now, Fitch and S&P previously stripped the U.S. of its highest investment grade. So the world is starting to shift in its confidence because the U.S. budget gap doubled between 22 and 23. Wait a minute. We didn't really have a whole lot of problems in 22, between 22 and 23, did we? I mean, we're told that our economy is really strong and chugging right along. What matters is less the aggregate rating and more the constant reminder to markets that fiscal risk is rising. If that were you, and it doesn't matter whether you are a government, a corporation, or an individual, the laws of economy and finance work the same for everyone. The difference is that governments and central bankers have a money gun, and they can just print money at will, counterfeit it, because this is real money. JP Morgan said, only gold is money. Everything else is credit. That means that it's debt. That is an accurate statement. So let's take a look at what is really happening and how it's likely to impact you. Because revenues are decreasing. Income tax, Fed remittances, we've talked about both of those. Auction proceeds and California tax receipts are all lower. At the same time, increased spending on debt interest rates, Social Security, the FDIC bailouts, which I thought was really interesting since they told us back in March and April and June, don't call this a bailout. It was a bailout because they weren't ready for you yet to know about the bail-ins, Medicare and defense. So all of those spendings have increased while their revenues have decreased. Can you see the problem? Can you see why the fiscal risk is rising? Because Moody's downside risk to the U.S. fiscal strength have increased. What are you waiting for? They want you to rush in and fill this gap in all the treasuries that they want to sell to you because the normal buyers are out or at least severely reduce their purchases. They need you, the public, to buy more debt so they can do more of the same and rob you more. U.S. kicks off fiscal year with an 87% surge in interest costs. The fiscal year ends in October. So this was written on November 13th. The budget deficit shrank in October because of deferred taxes, but the interest costs climbing due to rising treasury yields is really a problem. And this is for the fiscal year through September, actually, not even October, effectively doubled. U.S. debt interest bill rockets past a cool $1 trillion a year. And keep in mind that the issuance, not just from 2020 as the government was dealing with the pandemic, but all of the debt that has been issued needs to be refinanced. Who's going to buy? That's the question. Besides deficits of over $2 trillion in the foreseeable future, climbing maturities following the increase of issuance from March 2020 will also need to be refinanced. Well, the more debt they take on, the more interest they have to pay. And those interest payments can crowd out other spending programs. Like we saw, well, if you watch Mantra Monday, we've seen this just recently in, where is it, Chicago? Or there was somewhere New York City, that has to reduce their police force because of the interest on the debt that they're paying. All right, well, let's take a look at this. The federal government already spends more on interest than on budget areas such as veterans benefits, transportation, and education. In this fiscal year, spending on interest will become greater than mandatory spending for income security programs. So SNAP, earned income, child and other tax credits, supplemental security income, unemployment compensation, family support and foster care, and child nutrition. All of these programs, we're going to get to a point that this interest is going to crowd them out. They anticipate in 2024 that those interest payments will surpass the combined amount that the federal government spends on major health care programs other than Medicare. So Medicaid, children's health insurance programs, and premium tax credits. By 2028, they'll spend more on interest than on defense, and this could happen much sooner, especially with that higher for longer mantra. In 2031, the federal government will spend more on interest than on non-defense discretionary, which includes funding for transportation, veterans, education, health, international affairs, natural resources and environment, general science and technology, general government, and more. Can you see what I'm talking about? Because debtors want to get paid. They want to get paid. And this is why we're goofing around, our government is goofing around with our credit rating, because the lower the credit rating is as well, guess what? The higher investors' demand for taking that risk. Of course, they can hide that risk for a long time, sovereign debt, government debt. But this is through October 24th, the federal surplus or deficit. And you can see what I was talking about before. We actually had, no, it wasn't a counting gimmick. It wasn't real, but okay. We actually ran a surplus back in like 99, right? And you can see that once we went off the debt standard, it's deficits ever since. Well, this is 2008 right here. This is 2020 right here. And you can see that it's going down again with all of this spending. In 1971, the deficit was $23.3 billion. Now it's $1.7 trillion. Compounding interest. Compounding interest is not a good thing when you're the one that's paying it. Think about your credit card bills, right? If you don't pay all the interest plus principal, then you start to compound interest. You're never getting out of debt when you do that. And this is what it looks like. This is the federal debt, the total public debt, which is north 33.7 trillion in October of 2023 and going much higher because of all of the debt issuance. And, you know, the other part that I want to point out, all of these gray bars are official recessions. And you can see that every time we hit a gray bar, the speed at which we grow debt is faster and faster and faster. So welcome to that hockey stick where we are essentially, well, look at this. We were straight up there. We're straight up. We're straight freaking up. How can you afford that? And how about that appetite? So again, I go back to institutional investors that invest your money in mutual funds, in ETFs, in 401ks, in IRAs, in pension plans. Because they're not the ones that are going to eat it in the shorts. You are. You may not have choices, but I'll tell you right now, if you don't have choices, you better balance out your portfolio with gold. Because that's going to give you true diversification. And you think that investors are going to demand higher interest rates for the added risk? So the markets are going nutty on the Fed pivot, but those are the markets, those are the interest rates, the overnight markets that they can control directly. Indirectly, it's buying more of the debt to create an illusion of demand, and they're trying to run off their balance sheet to give them some headroom to grow that balance sheet again. But we are in such a precarious position, you just don't realize it. And this is federal government interest payments on the debt. And remember, we're not really seeing the truth because there's compounding interest in those deficits. They don't talk about that. God forbid they should talk about that. But you can go into the Fred. You have all the links on the blog. You can go into the Fred, and actually the one that you would go into would be this one, the total debt. And you can click a button and you can see the total debt all the way back and do your own calculations, and you'll see that what I'm saying is true. But even when you're looking at this, these are the interest payments, and look at how that has spiked since 2020, even ignoring the fact that the interest on that debt is compounding. This does not reflect that. That simply reflects the interest on the debt, period. So I think you can see how we already are at that hockey stick level of going straight up. And what's the mantra? Higher for longer, higher for longer. Well, it's a big problem when they've got to issue a whole bunch of debt. But you can see where we are in the interest, the Fed funds effective rate, because this is the rate that the government or the central bank controls directly, the overnight rate. And you can see, that's broken out, et cetera. But if the government is spending more than it's making, they're borrowing to pay the interest on the debt. And that's exactly what's happening. And therefore, the laws of compounding ensure that the interest on the debt will crowd out other spending. They're going to have to reduce security. They're going to have to, they're really going to pay for infrastructure? No, just like they've been postponing it forever and ever and ever. They're going to be raising taxes. They don't have any choice about that. This can help protect you from that. So you have to get used to, like the Bank of England said, get used to being poorer. Well, is that okay with you? Because I suggest you click that Calendly link and get a strategy in place and get it executed and fight. That's how we fight. We fight with our wallets. You're going to stay in the system? That's your vote. You're going to buy gold and silver and pull it out of the system? That's my vote. What's your vote? S&P defies Fed pushback in longest win since 21. The markets no longer believe the Fed. It's bets on that Fed pivot next year that sends bond yields sharply lower, but it's having problems getting past a certain point because of all the problems that we've discussed, not just here, but ad nauseum for quite some time. The really important piece of this is that the markets no longer believe the Fed, and confidence is critical in a Ponzi scheme. It's critical. You gotta have that confidence. And they gave it up. That was like a key tool that they had. They don't have that anymore. And oh, by the way, how much more interest will markets demand? Because when the Fed does pivot and pushes those rates down, how much damage will have been done to that point? Not just in our confidence and our trust in the markets, but in what's happening in all of the markets. How many of those zombie companies will be out of business because they're on the verge of it right now? How awful is the landscape, the market landscape going to look because of these high interest rates? They got us used to this hopium of, free money, which I already did this, so there's no more in there. But they've already gotten us used to zero interest rates and all of this free money. It's like an addict. You have to keep giving them more and more and more to make them seem normal, but it comes to a point where it doesn't matter how much you give them. Nothing's going to work. And that's what Ray is talking about. That's what I've been talking about. Are you ready for that? We don't have years. Look at where we are. We don't have years. And it's going to impact the level of interest, both of these things, the Fed credibility and the demand from investors, which we've seen, will have an impact on the level of interest on this mountain of compounding debt and compounding interest. Broad-based buying. So what's the solution? Well, let's see what the central banks are doing for themselves, because who knows more about what they're doing than they do. Broad base of buying, which suggests that increasing gold allocations are becoming an accepted prudential strategy across the segment. You think? This is global central bank buying through the third quarter. So we just got this. And let's take a look at that being the highest that they have done on record. The highest. And we haven't completed the year. Why do you think global central banks are buying so much gold? Because they know he or she who holds the gold holds choices and freedom. Holds your freedom. And if you are self-sufficient with food, water, energy, security, barterability, wealth preservation, community, and shelter, you've got your freedom. You've got your choices. And they can't force you into compliance. You keep everything in the system, you're forced into compliance. You're not going to have any choices. I want everybody that's watching, I want everybody that's not watching to retain those choices. Central bank demand for gold saw no let-up in Q3, building on the record-breaking first half of the year. Global official gold reserves rose by 337 tons, 120% higher quarter over quarter, and the second highest third quarter totaling Q3 in 2022. On a year-to-date basis, central banks have bought an astonishing net 800 tons, 14% higher than the same period last year. What does that tell you? I believe so strongly that you should always do what the smartest guys on any given topic are doing for themselves. I have shown you ad nauseum how easy it is to manipulate that paper contract spot gold market. That takes nothing. It doesn't even take very much money. Easy peasy to manipulate. It's the physical market where we see the truth. And whether you're looking at the top tier or the average tier, those have both broken out because demand is exceeding supply. It's a true demand supply market. What are you doing about it? The other thing that I want to keep in mind is that it's not all doom and gloom. And being in the right place at the right time with the right asset puts you in a position where you can retain your this is your freedom for yourself, for your family, for people that you love and care about. Because everything else is a lie, everything else is a contract, everything else runs counterparty risk. Speaking of that, you make sure that you watch the latest video on the municipal debt danger, because we think that these things are so safe. It's the way they've been sold to us, and they're not. Additionally, I'm sure you are really loving the lineup that we have put together with Daniela Cambone and Taylor Kenny. I mean, we have such a good team on this desk. I'm really proud of us. And again, if you haven't done this yet, click that Calendly link below and start your gold and silver strategy and get it executed. Because having the right gold and silver for your objectives and your goals is absolutely crucial. And you want to do it when you have the most number of choices, which is today. Tomorrow, I mean, I've seen choices be reduced since I've been accumulating. Who knows about tomorrow? This is a physical demand and supply market. If it's off the market, you're not going to be able to get it. So you want to get this done and executed ASAP because we are absolutely running out of time. And if you haven't done it yet, make sure you subscribe, leave us a comment, give us a thumbs up, share. And remember that this is your wealth shield. And until next we meet, please be safe out there. Bye-bye.